Hello, my name is Tina Mitchell, your local mortgage experts with Gateway Mortgage, and I wanted to share what's happening with mortgage interest rates. But I first want to start out with what's happening with the feds and what the feds have done. They have lowered the Fed fund rate from 2.5 to 2.25. Now, this is the first time that they've lowered it since 2008. The drop started in September of 2007 to try to get under control the financial meltdown, and it continued to drop almost every month, all the way to 0%. So it went from 5.25 to 0% in drops happening up until 2008. Now, what the Fed funds rate is what banks, the cost for banks to borrow from each other. And then the prime rate, which is the cost for consumers to borrow, typically will follow the Fed fund rate. So the current prime rate right now today is at 5.25%. Now, a lot of times consumers are confused to thinking that the prime rate, when the prime rate lowers, that directly affects mortgage interest rates. It does not. Mortgage interest rates are based on how the bond market is trading and is tied to the Fannie Mae 30-year bond. So what the prime rate is for short-term loans. So when the feds lower prime, that is going to affect what it costs for you on your credit cards. You won't always see a direct effect on credit cards because there's contracts that are in play, and so you want to check with your credit card company to see if your rate is dropped. But any new credit cards you're getting, home equity line of credits, because those are short-term loans. Sometimes car loans will be tied to prime as well, and then what you're earning on your depositories at the bank typically are going to improve. So I want to give you a visual here so you can see the prime rate compared to mortgage interest rates. So if you see here, the red represents prime, your short-term lending. And as you can see here, this is where prime started to increase. And then here we're moving over here, and now we're heading down again. If you look at the mortgage rate, the 30-year mortgage interest rate, you can see it kind of followed here. Here the prime went up, mortgage rates went down. Here the prime rate went up and mortgage rates went down. So as you can see, they are not directly tied to prime. What the Fed's role is to manage inflation and to maintain a balanced market. So when the feds are lowering prime, they're trying to stimulate the market to make it less expensive to borrow on short-term financing. Now, depending on the Fed's plan or their goal, whether that works or not is going to determine what's going to happen with mortgage interest rates. So if we have a stronger economy and there's consumer confidence, investors are going to invest into the stock market. They'll take a little more risk because of the higher return, correct? Now, if there's a drop in consumer confidence or lack of consumer confidence, investors are going to pull out of the stock market and they're going to go into the security of the bond market. Lower return, but it feels safer. So since mortgage rates are directly tied to the bond market, directly tied to the Fannie Mae 30-year bond, when the stocks are doing well, the bond market is not. Bonds are dropping and mortgage rates are going up. When the stock market is not doing well, and again, there's not as much consumer confidence, being that investors are going into the bond market is going to improve, trading at a higher return, which means mortgage rates are going to go down. So it really just depends on the Fed's movement and what they decide to do and how that's going to affect the markets. Strong market's good for stock market, bad for bond market, and bad for mortgage rates. Lack of consumer confidence, again, is good for the bond market and good for mortgage interest rates. So as I wrap up my time here with you, I do want to share a visual of mortgage interest rates. So this is a chart that goes all the way back here as we get into before 1975. And I want you to take a look at it, that because even for myself, I started in the mortgage industry in May of 1995. So I have no idea what it was like here when mortgage interest rates were 13, got all the way up to over 18%, if that gives you a little bit of perspective on mortgage interest rates. Now, where we saw the historical lowest interest rates, as long as they've been tracking, was in December of 2012. That's when we saw the rates hit the lowest. Now, the lowest that we've seen interest rates in the last few years was in July of 2016. So where we're at right now is not at the lowest that we've seen historically, or even the lowest that we've seen in or the last few years, but we're right back to where we were in about the last 3 years of July of 2016. So mortgage interest rates are on an average of 3.75%. Again, the lowest being in December of 2012. So we're almost at the lowest. So this is a call to action for you. If you've been sitting on the fence, possibly not purchasing a home when you want to, because it's been a little bit of a challenging market for buyers, we are still in a seller's market. We are not in a balanced market, definitely not in a buyer's market, but we are closer to a balanced market because we've seen more inventory come up on the market. And now that mortgage interest rates have hit almost another all-time low, it's a really good time to get out there and purchase. Every 0.25% in interest rate is about $10,000 increase in your buying potential. So think about that. If you had an extra $10,000, would that help you get into a better home? Also, it's a shout out if you're thinking about refinancing, take a look at what those numbers might look like for you to see if it makes sense for you to lock into a lower interest rate than what you might have now. I hope my information for you today was helpful, talking a little bit about what the feds are doing, how that's affecting a direct effect to the Fed fund rate, as well as the effect to the prime rate for short-term financing, and what's happened with mortgage interest rates. If you have any question, please feel free to reach out to me, 425-647-0205. And again, I am Tina Mitchell, your local mortgage expert with Gateway Mortgage. Have a great day.